My name is David Siegel, and I'm a professional heretic. In the next 10 minutes, I'm going to talk about monetary policy and its role in the economic recovery from the 2020 pandemic. I believe that long-run economic growth solves many of the world's problems: poverty, education, literacy, democracy, health, mortality, lifespan. All these things have improved dramatically over the past 40 years. The two big drivers are innovation and monetary policy. In this short video, I'll take a few minutes to review monetary policy in the past and present, and I'll spend most of the time describing a new approach that will not just help us get out of our current situation, but will create long-term growth for the future. Economists generally assume that GDP is a good driver of quality of life. So if we can maximize the long-run growth of GDP, we can probably help the most people. But periodically, we have recessions, shown here in gray. When there's a recession, many people lose jobs, but poor people are hurt the most. I claim that almost all of these recessions were the result of bad monetary policy. In the past, when there have been shocks to the economy, the Fed was always too worried about inflation, so they did what I call too much, too late. Overall, monetary policy has made most shocks worse, not better. And the Great Recession was no exception. The standard story is that the 2008 recession was caused by a glut of housing, subprime loans, over-leverage, and bad incentives. I don't believe the data shows this to be true. I won't go into too much detail, but in the first half of 2008, jobs were down, prices were up. By August, it was possible to see that economic growth had turned sharply south, and by September, both unemployment and growth were going in the wrong direction. There was an election coming up, uncertainty was very high, and that's exactly when the Fed did nothing. Fearing inflation, they inadvertently put the brakes on the economy when they should have been printing money, stepping on the gas pedal, and stimulating growth. That fall, the European Central Bank actually raised interest rates, and the hole in the worldwide economy never recovered. This all happened not because of housing or banking, but mostly because money was too tight. With better monetary policy, we probably wouldn't have had a recession at all. This year, we've seen a severe shock, and the government has responded with fiscal payments to individuals and businesses, as well as some quantitative easing. History has shown that fiscal payments are short-lived and ineffective. They increase debt and don't increase the velocity of money in the economy. Sure, you need to address the immediate needs of hospitals, medical personnel, police, the unemployed, critical workers, and others, but the creation of new money benefits more people in the long run. So far, the Fed has printed $1.4 trillion in new money. Isn't that going to create too much inflation? When people hear the Fed is printing money, they freak out. They think of Venezuela or Zimbabwe or the 1970s, fearing that inflation will rise. This pushes up the price of gold as markets expect inflation to run away. But is that a real concern? How much inflation do you think there is right now? Take a guess. What's the inflation rate today? One way to have a sense of inflation is to think about the prices of all non-food items you buy. Have they gone up or down in the last few months? Well, no matter how you measure inflation, the Fed generally hasn't hit its target of 2%. That's shown by this red line here. This year, inflation is way down. Despite $1.4 trillion in new base money, it's less than 1% right now. Where do you think the inflation number will be by the end of this year? Can you guess? The Fed itself projects this year will come in under 1%. So there isn't much chance of runaway inflation. Remember, the target is 2%. They can absolutely hit that target if they want to. They can just increase the quantity of money, and that will stimulate the economy to come back as soon as we're all able to get back to work. In fact, it would give people more incentive to find productive ways to work from home. But they don't plan on hitting their inflation target anytime soon. In other words, right now, money is too tight. This is not ideal. This makes any recovery harder. The Fed is in a difficult position because if they could raise inflation to, say, 3 or 3.5%, which is where it should be right now to make up for months of low inflation, everyone would worry that it would go higher. It's hard to know because the Fed keeps everything secret until they surprise us with big announcements every quarter or so. The Fed understands that there's no trade-off between the economy and the virus. I want to repeat that. The Fed understands that there's no trade-off between the economy and the virus. The economy gets better as we solve the healthcare problem. That's good. The Fed wants to do its part to stimulate the economy as best they can. That's also good. But they have a history of making shocks worse, not better, because they're trying to maximize too many variables at once. I want to give the Fed a rule they can follow to automatically do the right thing without ever having any meetings or announcements. It's called nominal GDP level targeting, created by Scott Sumner and other market monitorists. I want to break it down at a high level here because I think it's the single thing governments can do to help recover from the current shock as well as future shocks and prevent future recessions. First, what's nominal GDP? Well, it's just all the money that changes hands in the economy during the year without making any adjustments or calculations because people pay the actual price for goods and services with inflation built in, not subtracted out. So think of it as the cash register price of everything bought and sold and the actual amount on paychecks. It's a true measure of aggregate demand. If the Fed were to target nominal GDP growth, there'd be no trade-off between inflation and growth. And I want to show that. The Fed would only just look at one number, nominal GDP. So if the Fed sets a target of, say, 4% nominal GDP growth by the end of the year, it doesn't matter which GDP or inflation are, as long as they add up to 4%. Here, GDP might be projected to come in at 3% and inflation at 1%. That's on target. In another year, like this one, you might settle for less growth but create more inflation by buying assets. Inflation increases the velocity of money. It makes money like a hot potato. People would rather spend now than hold, and that helps stimulate the economy, especially during a demand shock like we have now. So this combination here is also on target. Later, growth might be strong, but inflation might be a bit too high. In that case, the Fed would sell assets, unwinding the trades, destroying enough money to bring inflation down to 1%, thereby hitting the target. The Fed shouldn't care what the individual numbers are as long as the total is 4%. Level targeting means you promise to hit your target number and you do it. If you undershoot one year, you overshoot the next, so that on average, nominal GDP comes in exactly on target. Properly done, level targeting acts as a damper rather than a spring. Without level targeting, the Fed could drive up inflation, but people wouldn't know their intentions and markets won't know what to expect next. With level targeting, there's no more guessing and markets are more efficient. Now, the Fed could do this using a rule rather than by making decisions. They could make a daily adjustment to the money supply based on projected nominal GDP, which would result in a buy, sell, or hold, and send a constant signal to markets every 24 hours. There would never be any committee decisions, announcements, or surprises. We're in a difficult situation right now. Nominal GDP level targeting can't keep people safe at work, and it can't put people on airplanes. But it would do almost all the heavy lifting in recovering from a demand shock, much more than fiscal policy would. I want to emphasize that even though we need 3% inflation now, it would be a bad strategy for the Fed just to print enough money and deliver inflation. That's not what we need. Instead, the Fed should declare their commitment to nominal GDP level targeting and adjust often enough to make that threat credible. Will we have a V-shaped recovery? Well, let me just do a quick thought experiment. How many people watching this would rather live in the world where the Fed did not print $1.4 trillion back in March? I don't want to live in that world. I think it was important that they printed that much. In fact, if they had printed $3 trillion, which is more like what I think they should have printed, and And if they had actually done that, and I asked the same question, how many people want to live in the world where they didn't print 3 trillion? I think everybody would be pretty happy, actually, at this point with printing 3 trillion. And we would not want to live in and run the experiment the other way without the money printing. So I think that shows. I've asked a lot of people this question, and they agree that it's better that the Fed printed money than doing nothing. But no matter what happens next, nominal GDP level targeting is better than fiscal stimulus, and it's better than our current policy. It would give us the inflation we need to bring interest rates back up and normalize our economy as soon as possible. As our currency goes digital, we will be able to fully automate our monetary policy, write it into software, set it and forget it. That will give us the best chance for fewer recessions, long-run economic growth, and increased quality of life.